agenda for today is we would be looking at all the important concepts which were covered in CFA level 1 derivatives, which are going to be useful for CFA level 2. Okay, so my assumption is that you people remember CFA level 1 derivative in bits and pieces. Okay, so I'm going to assume that at least you remember the basics, that what was forward, what was future, but I'll try to be as comprehensive as possible. So I did go through the new learning outcome carefully, and then I listed out these are the items that we need to remember from the level 1 syllabus. Okay, so we are going to start with the first one now. So you can also make notes parallelly along with me. We are starting with the basics of forward contract. So we would look at structure, pricing as well as valuation, all the three components. So number one, what is a forward contract? There are two parties. The first party is called long. The other party is called short. They enter into an agreement with each other. The party which is long will have right and obligation to buy, and the party which is short will have right and obligation to sell. So sell what? Sell a predetermined quantity of underlying asset. Underlying asset could be either equities, or it could be, tell me, bonds, or it could be commodities, currency, any asset. So underlying asset, a pre-specified quantity, and most importantly a pre-specified price at some pre-specified future date. Right, so this is what we say is the forward contract. Do you remember the Shetty's story we had discussed at level 0? So one party agrees to buy, other party agrees to sell. Now long has a motivation, his incentive is then he will make profit if the value of asset goes up, and therefore we say that long is bullish on the underlying asset. Short will benefit if the value of underlying asset goes down, and therefore short would be referred to as bearish. For example, let us say the contract price is 50. Now on the date of maturity, if the price of underlying is 70, then who will benefit? Long, because a 70 worth of asset he will have a right to buy at 50. But if the underlying asset is worth 20, then short will benefit because 20 worth of asset he will sell for 50. Are we okay with this? So this is roughly the structure. Now, is there any margin involved in forward contracts? Yes or no? Typically no. Why? Because it is a OTC contract. However, post 2008, with whatever regulations, what happened in US market and Frank and Dodd and all those regulations. So today most of the structured OTC products, they also require margin. Okay, so which means if it's an OTC product, then, and if it's under US regulation, then some of the products might require margining system. But for exam purpose, right now we will just say that there are no margins. Why? Because it is an OTC contract, and one of the benefit of OTC is it allows you to customize. Now I'm open to questions. Any questions you would like to ask on this front? No? Okay. So once you are okay with structure, then the next two component is pricing and valuation. So the first question that comes, what is the price of the contract? So in our example, we said long had a right and obligation to buy at the price of 50, and short has a right and obligation to sell at 50. So that 50 which is mentioned in the contract, we will call this as the price of forward contract. So when we say the pricing of forward, what we essentially mean is finding out the price that should be mentioned in the contract. Now imagine one of the party, in fact the parties sign the contract, and next day the underlying asset value changes. So the moment underlying asset value changes, then one of the parties will have a profit, other party will have a loss. So when we try to find out what is the benefit, what is the profit or loss of either of the party after signing the contract, okay, so At time 0, when we sign the contract, can I say the value of contract has to be 0? Yes or no? Otherwise the parties will never sign. But the moment you sign the contract and then price of the underlying changes, then one of the parties will have profit, the other one will have losses. So finding out what is the profit or what is the loss, that would be referred to as valuation of the forward. Are we together on this? So now let's spend some time and understand, let's do a little bit of numbers with pricing and valuation. So let's say the spot price of a particular asset is 100. Let's say current risk-free rate is 10%. And we are looking at a 1-year forward which is available at the price of 150. So I want you to use some logic, make reasonable assumption, and tell me if you can exploit some arbitrage out of this transaction. Can we exploit some arbitrage out of this transaction? Yes? How can we do it? So this type of arbitrage, if you remember from L1, we will call this as cash and carry. Right? So what do we do here? Step number 1, we go to a bank and we will borrow 100 at the rate of 10%. Step number 2, with that money, we will take long position on underlying asset. Okay, so whatever money that you borrowed from the bank, you use that money, you purchase the asset. Step number 3, you will take short position on the forward contract. So this is what you do today. After 1 year, this short position will give you right as well as the obligation to sell at 150 no matter what is the price in the market. So the asset that you purchased last year, after 1 year you will sell it at 150. So the asset is already with you, so you will convert this into 150 amount. Out of that 150, how much will you pay back to the bank? 110. So how much are you left for yourself? 40. So that 40 would be referred to as your arbitrage in this example. Correct? This is the profit that you've been able to earn because the forwards were mispriced. So step number 1, borrow. Then using that borrowed amount, buy the stock, enter into short forward. Short forward will give you a right and obligation to sell at 150 1 year down the line. You already have the asset, sell it for 150. Take 110, give it back to the bank. Your transaction is closed. 40 is your arbitrage profit. What if 1 year forward is available at the price of 80? Then what do you do in this scenario? So now the arbitrage that you'd use, this would be referred to as reverse cash and carry. Okay, so here you will say step number 1, short sell stock at 100. Short selling is selling a stock without having it. We are going to make theoretical assumption that we have received that 100. So step number 2, invest 100 at the rate of 10%. Step number 3, take a long position on the forward contract. Now this long position on forward contract will give you right and obligation to buy at 80 1 year down the line, no matter what is the price in the market. Are we together on this? So with 80, you will buy the stock, and the stock you would give it back to the broker from whom you had borrowed originally. But how much will bank give you? Bank will give you 110, out of which only 80 was used. So how much is your arbitrage here? 30. So this is your arbitrage profit. So which means if the price, forward price is more, there is a cash and carry arbitrage. If forward price is less, there is a reverse cash and carry arbitrage. In both the cases, what do you think would have been the price at which there was no arbitrage? 110. So imagine what if the forward price was 110. If it is 110, you will sell at 110, you will give back 110 to the bank, no arbitrage. If forward price was 110, then that is the money that bank will give you, that you will use to buy, and then you will give back the stock. In both the cases, no profit. Can I clear the screen? So this gives us the formula of no arbitrage forward price. So we are pricing the forward here, and no arbitrage forward price here is spot into 1 plus RFR raised to n, or spot into e raised to whatever is the r into t. So if you are using continuous compounding, this is a formula you use. If you are using discrete compounding, this is a formula you'd use. So just to maintain consistency, maybe we can write t on both the sides. So we are using t here. So let's practice one question on either side. Let us say spot price is 250, RFR is 12% per annum, and your maturity is 6 months. Find out no arbitrage forward price. Spot price is 370, RFR is 8% per annum, compounded continuously. This rate was assumed to be, if nothing is mentioned, we assume annually. Maturity is 171 days. Find out no arbitrage forward price. So how do we do this one? 250 into 1 plus 12% raised to 0.5. We would not say 250 into 1 plus 6%. Agree? 1 plus 12% raised to 0.5 is different than 1 plus 6%. So this number will come out to be 26.57. So this is the price of the forward contract. In this example, 370 into e raised to 0.08 into 171 divided by 365. So the keys on your calculator would be, have 0.08 on the screen first, then multiply with 171, divide by 365, then say second e raised to x, then multiply with 370. 384.13. So this concept is extremely essential because more or less half, about 50% of your first reading at level 2 kind of builds on to this concept. Okay, so if you are conceptually good with this, you are going to find that stuff quite easier. So now we are on to valuation of forwards. Okay, so level 1 did not have explicit numericals on this, but we did solve a few questions in the class just to get comfortable. And if you remember that part, we had decided not to use a formula because we could build some analogy and solve it without a formula. So we'll try to do the same example now. So let's say this distance is 1 year. This is 0, this is 1 year. Today the spot price is 100, RFR is 10% discrete. So no arbitrage forward price comes out to be 110. Okay. Let us say we have taken a long position on this forward contract. So we sign the contract at time 0. Are we together on this? Now after 3 months, the price of the underlying has become 120. And now we want to find out what is the value of the contract to long position. Now, without calculation, can you tell me if long is making profit or losses here? Is long making profit or losses? Are you sure? Because the price of the underlying has gone up. So long is making profit. Now, there are multiple ways through which we can find out how much profit is long making. So the most logical way to approach this question, we will take this 120 forwards for 9 months. Okay, so what this guy will do is, he will call up the dealer. He will say, 3 months back, with your help, I entered into a contract. I was on long position. Today, I want to check with you what is a forward price for the same underlying asset but with maturity of 9 months. Is that okay? Please quote me a new forward price, same underlying asset but remaining maturity of only 9 months. So the dealer will do exactly the same calculation that we just learned. He will say 120 into 1 plus 10% raised to 9 by 12. Yes or no? So he will give us a new forward price. Tell me how much? 120, 8.89. Now the moment he quotes you a price, you tell him, fine, please book a contract for me on the short side. Okay, if you want to. So you would immediately ask him to book a contract for you on the short side. So now what is the story now? 9 months from today, I have a right and obligation to buy at 110. And 9 months from today, I have a right and obligation to sell at 128, no matter what is the price in the market. Which means no matter what happens, as long as there is no default, on that particular day, we are going to earn profit of 18.89. Is this the value of forward? So this is the profit I am going to make 9 months down the line. We would want to know what is the valuation or the amount of profit today. So we will take that 18.89 backwards for 3 months. So 18.89 divided by 1 plus 10% raised to 9 by 12. How much? 17.58. So 17.58 is the answer that we were looking at this question. Any questions? So are you able to appreciate the difference between price and value? So the value is, now this individual who is on long, he will call up the dealer. He will say, if I want to exit today and if you would allow me, then how much profit or how much money will you give me to close the contract? So if the dealer says any amount less than 17.58, then this gentleman will show him the calculations to see, I can do this. Your current quote is 128. I already have long on 110. I am anyways going to make profit of 18.89. So the present value is 17.58. This is what you should pay me. And of course the dealer will have no motivation to pay him more than that. Correct? So theoretic valuation, ignoring transaction cost and all other elements, the theoretical valuation of this forward would come out to be 17.58. So there are 3 ways in which you can solve this question. One more way. Please take present value of this 110 backwards today. Please take present value of 110 backwards today. 10, 2.4. Now please take the difference between 102.4 and 120. Same. There is one more way. Please take future value of 100 for 3 months. Future value of 100 for 3 months. Same, and again take the difference. Okay, so you can solve the same question using multiple mechanism, but for the exams and even for concept building, this is the way to go. You will understand why. Because this technique, the first technique that we developed, that's generic. It will work on interest rate derivatives, currency derivatives, everywhere. with dividend, without dividend, with coupons, without coupon, continuous, discrete, no matter what, this technique will never fail you. You will not be required to remember a single formula. So what is the intuition? Find out new forward price, take the difference, that's your profit or loss, take it backwards. That's it. End of the story. 17 point? It's today's profit, yes. So this is the value of the forward contract. So again, when we start with specific learning outcomes, we'll have a lot of practice, but today we're just building an overview. So even if you've not understood specifics of the calculation, but if you've just understood the difference between price and value, you're still going to be okay. Are we alright here? Should I clear the screen? So we are done with the first one. Let us now start looking at the future contract basics. So future contract is a more scalable, standardized version of the forward contract. The contract essentially remains same, but it comes in a different form and structure. So what we have now in the center, is an exchange. And then all the parties which would want to take long position here on one side, all the parties which would want to take short position are on one side. They are going to put their requests into the order book of the exchange. The same contract, but now it's going to be electronically mapped. So some of the important differences between forward and future. Number one, future contracts are standardized. So when we say standardized, they're standardized in terms of quantity, which we typically refer to as lot size, right? So you cannot put any random number. Your quantity would be a function of what is the lot size that is defined by the exchange, correct? Another benefit of this is it gives you fungibility. For example, long wants to have a position on, let us say, 10 contracts, and short wants to have a position on 7 contracts. So at least we can map 7 contracts, so it breaks down that larger order into smaller parts. Second, it would be standardized in the context of maturity. So 1 month, 2 month, 3 month, you cannot define your own date. You'll have to select based on whatever options are provided to you. Second important element is the concept of margin money. This margin money works as some sort of a security deposit, that in the context that one of the parties default, clearinghouse will take that money from one's account, put it into other account. Plus in futures we have mark to market settlement. That means, so you can think of mark to market settlement as kind of pressing the refresh button into a computer. So you refresh your contract. Okay, in the morning, yesterday I was having discussion with level 1 guys. So imagine that you enter into a forward contract on the long side at 100, and then price of the underlying became 150. So how much profit do you earn here? 50. This is how forwards work. How futures work is that you started with 100, okay, 100 became 110 next day. So immediately you take out your profit of 10. Are you following this? So immediately that 10 profit comes to you, and now it's in a way the new contract starts, but it starts at what price? 110. So next day if 110 becomes 115, you have already taken up that profit of 10, now you will take up only the profit of 5. So this mechanism we discussed at level 1, we call this as mark to market settlement. Is that okay? Then third important element, because you have a margining system, there would be no default, right? In futures, a counterparty will not, in fact, who is your counterparty in a future contract? Your counterparty is the clearinghouse, because it is going to split the trades. So there would not be default because of the margining system. And then of course differences like how do you offset the trade, and then transaction cost and other smaller differences. Any questions here? That depends on the system of the broker. Some brokers will consider consolidated positions. Some brokers will do trades on individual positions. The question he asked, like if I have, it happens also with options to a lot of people. If you have multiple positions, so all the margining amount that needs to be deposited, should that be done on an individual basis or should that be done on a consolidated basis? Okay, so logically from a risk management perspective, it should be done consolidated basis, because if you have a long and short position, in a way you're nullifying. But that is mostly available to institutional investors, where brokers provide them that consolidated platform. To most of the retail investors, it is done on one-on-one basis. Are we okay? Then so we've discussed margin. Settlement of futures, typically you enter into an offsetting contract. Anyways, your mark to market gets deposited in your account every day. So if your profit or losses anyways has been taken care of, you enter into an offsetting contract and the position gets squared off. Okay. Next concept is options. I'm quickly going to revise the flowchart we had built. So we can have either a call option or put option. Then we can take long position or we can take short position. Long position, short position. The first thing to appreciate, if you're on long, you're always going to have a right. So whether it's call or a put doesn't matter. If you're long, it's a right. So long is right. In case of call option, that right is to buy. So long call, right to buy. In case of put option, that right would be to. Now, short is the counterparty of the long. So if a long has right to buy, short is always going to have obligation here, and this short is also going to have only an obligation, and that's what we refer to as the asymmetry of the contracts. Are we okay here? Now if this guy has right to buy, then short is going to have obligation to sell. So this is obligation to sell, and this is going to be obligation to buy. So right to buy, obligation to sell, right to sell, and obligation to buy. Now if you have a right, are you going to get that free of cost? No. So to get that right, you will have to incur some cost. In option world, that cost is called premium. So this party will pay premium. So I'm just writing as PP. But he will pay premium to whom? To short. So short is going to receive premium. So pay premium, receive premium. How about long put? Will he pay or receive? Long put, does he have a right or obligation? Right. So the right, to get that right, he will have to pay premium. This party is going to receive premium. So let us say we are looking at an example where strike price is 100. This strike price is also called as exercise price. So strike price 100, premium of 10. Now let's look at different scenarios for a underlying asset. So let's say it becomes 0 or 40, 110, 170, 250. Right, so be with me on this. We are thinking from long call perspective. You would say I have a right to buy at 100. Price in the market is 0. First example, price in the market is 0. So a 0 worth of asset I am buying for 100 and paying a premium of 10. My loss is 100 and 110 or just 10? How many of you think 110? ऐसे ही हो गया ना आपका एकदम से. So here you would say I have a right to buy, and because I have a right to buy, I would not buy. Why would I buy an asset worth 0 at a price of 100? So what I would lose is just this 10. Will you buy a 40 rupee asset or a $40 asset for 100? No. So what you would lose is premium 10. Will you buy a 110 worth of asset at 100? You would buy 110 asset at 100? Yes. And then what would be the payoff? Payoff 10. But premium paid 10. Profit 0. So this is 0. Will you buy this asset at 110? Yes. So payoff 70, premium 10, profit 60, profit 140. So this 110 would be referred to as your, tell me, break-even point. Are we okay with this? So at 110, you're neither making any profit nor making any losses. Now one trick that we discussed is that short side of the options are generally trickier to handle. So what we decided at level 1, we said we will always think from the perspective of long, and then we will switch the signs. So if you want to know what are going to be the payoffs for the short, you already have the answer. This is going to be plus 10, 0 doesn't matter. Then minus 60 and minus 140, and that's it. You have the payoffs or profits for short. So find out the values for long, reverse the sign, you will have values for short. Let's look at this side now. Strike price 100, premium 10. Let us say the underlying is 0 or 40 or 90, 170, 250. So you have a right to sell at 100, price in the market 0, we are thinking long put. Will you sell? A 0 worth of asset, will you sell for 100? Yes. So your payoff 100, profit 90. So here your profit is going to be 90. Will you sell a $40 asset for 100? Yes. So payoff 60 and profit 50. So this is 50. Will you sell a $90 asset for 100? Yes. Payoff 10 and profit 0. And here you would end up losing the premium because you will not exercise. So this is going to be minus 10. This is going to be minus 10. And the moment you have this, we can get the values for short. We will say minus 90, minus 50, 0, plus 10, plus 10. And of course, now we can see this is the break-even point. Maximum profit and maximum loss. Can I say maximum profit here will be unlimited? Yes or no? Why? Because you would make profit. Thanks. Because you would make profit when the prices are increasing, and prices can increase up to infinity. So maximum profit unlimited. But if things go wrong, what do you lose? You just lose what you had paid, because you only have a right, no obligation. So maximum loss is just the premium. When you're on the put side, when are you making profit? When the prices are going up or going down? Going down. So prices can go down up to minus 50, up to 0. So a 0 worth of asset you will sell for X. So X is your payoff, but you paid premium P. So X minus P is your profit. So maximum profit X minus P. How about maximum loss? Premium. So now remember this, when you're on the long side, you're never going to lose more than the premium. In the worst case, if things go wrong, that entire premium is lost, but you would never lose more than that. And the moment you have this, then we know profit of this person is loss of this person. So we can easily fill in the values for short. We will say this is premium, this is unlimited, this is premium, this is X minus P. Break-even point 110, which is X plus P. Break-even point 90, which is X minus P. This person here, who is long on call, he benefits when the prices go up. Therefore, we can call him bullish. This person who is short on call, he benefits when the prices go down. So we will call him bearish. Long put benefits when the prices go down. So we will call him bearish. And short put benefits when the prices go up. So we will call him bullish. So we try to remember this as B, 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 B. If you remember the sequence, life becomes much more easier. So how do you and when do you make money? So if you are in the first section of the flowchart or last one, you're hoping that prices go up. If you're in the center, then you're hoping that prices go down. Now let's add some incremental fun to it at level 2. So here you will say that you're outrightly bullish. Okay, so you're bullish, but you're a lot of bullish, as in you're expecting price will increase significantly. But this bullish, you're mildly bullish. That's the difference, right? So a lot of people wonder if both of them are bullish, when do I take which position? So when you're moderately bullish, then you would be better off going on to short put. But if you're outrightly bullish, if you're hoping a significant upside, then you would be better off going on to long call. In the same fashion, if you're outrightly bearish, go on long put. But if you're mildly bearish, then go on short call.